Kristina, I want you to follow me over to this chart over here because we had just released Yahoo Finance's chart book earlier this morning. It's taking a look at more than 30 charts that economists, strategists like yourself have sent over, really that's starting to, or reasons to consider these charts because in terms of what it could dictate, in terms of market moves, in terms of the economy here going forward. And this chart that you sent over, it goes along with what you were just talking about. Why is this chart important when you talk about the performance or the outperformance made that we have seen of the NASDAQ 100, despite the fact, and even in light of the fact that the Fed has kept rates at such an elevated rate?
So let me start by saying that tech stocks are viewed as a long duration asset class because the earnings are farther out in the future. And so they're viewed as being more sensitive to interest rate changes. And so what we have here is not just the NASDAQ 100, but the Fed funds rate, and then something called the proxy funds rate. That was created by the San Francisco Fed to take into account other monetary policy tools and how they create essentially a Fed funds rate, a monetary policy environment that could potentially be tighter or looser than just the Fed funds rate. What we see here is that clearly tech stocks are very sensitive to interest rate moves, but particularly so when PE ratios are higher. So I didn't include the PE ratios here, but the PE ratio right here was a little over 200. So as you can see, that was the start of that huge tech rout. And again, it was driven by interest rates. It was driven by higher sensitivity. But there were other periods in time where the NASDAQ wasn't very sensitive to interest rate changes, and that's when valuations were lower. Right now, we're in a place where the NASDAQ 100's valuations, the P ratio's around 32. It's higher than the historical average. So I think there will be greater sensitivity, but I don't think we're going to see the kind of sensitivity we saw when the PE ratio was over 100. So I think that's important to keep in mind when we think about what's going to happen and who's going to benefit the most from rate cuts. Certainly, I think tech will benefit, but not dramatically. I think where we're going to see the biggest moves, we've already started to see them, is in the cyclicals and the smaller caps because of what they're discounting in the future, that economic reacceleration driven by the Fed not making a mistake by starting to cut in time to avoid any kind of recession.
So then given that, though, even though they might not have a huge pop to the upside, they're still in a position to outperform even if we do see the Fed lower rates.
I think they're in a position to perform. I think they'll probably lag cyclicals and small caps, at least for some period of time. Again, that's if the thesis holds that we are able to avoid any kind of significant downturn and see that economic reacceleration.